Hey, welcome back. Since I bought a bit recently, I decided to do a follow-up on WBD. We can see a bit of growth in subscribers, pretty successful movies, debt repayments, and overall not a terrible start of the year. We see some decreases in Q1 after a very good quarter a year ago. However, Q1 saw a very significant increase in cash flow, and this is traditionally the worst quarter for the company. So you have a very significant increase in cash flows despite a decrease in operations. They repaid 1.1 billion of debt in Q1 and launched a tender offer to repurchase up to 1.75 billion. An update, they actually increased that to over 2.6 billion, so even better. They seem to focus on reducing the long-term debt from the 40s and 50s, which come with a slightly above average interest rate. They can refinance the medium-term one if needed, but more on that in a second. Just to point out, if they were struggling, they would have probably issued instead of offering to buy back around 4% of the total debt. A year ago, despite the strikes that lasted for almost 4 months, they made a cash flow of almost 6.2 billion. Q1 tends to be lower, but in the past 12 months, so Q1 this year and 2 to 4 from the last, they are getting close to 7.5 billion. For a market cap of around 20 billion, this is one of the cheapest companies you can find. Now, can they keep making even 5 billion? Well, if they can, then this will probably be a very successful investment. Because if they make so much money, a 10% dividend takes only 2 billion, so 40% of the cash flow. They are focusing on reducing the debt, however, which I think is a good thing. Now, probably the number one issue people have with this company is the high amount of debt. This is basically AT&T's legacy. However, despite being high, it's not as bad as people think. They have to pay around 2.2 billion in interest, and up until 2029, the average debt repayment is around 2 billion. So anything above 4.2 billion should be okay. Now, they can refinance and push it into the 30s if they really have to. You can see that after 2032, there isn't really that much debt to pay. One thing that I want to mention again is the way the net income works and why I prefer the free cash flow. We can see about minus 1 billion in net income in Q1. However, 1.9 billion of that is in depreciation and amortization, so this isn't really a, let's say, true loss, but rather an accounting one. The advantage in this case, and the reason behind the D&A, is that they get tax benefits. Depreciation and amortization are tax deductible. You know, think about the Lord of the Rings movies from the early 2000s. Many of the things that went into those movies are probably generating some amortization even today. But do they actually impact the company? No, if anything, they actually make a bit of money even today thanks to spending that money 2 decades ago, and they improve the overall quality of WBD's movie library. Anyway, if everything remains as it is, the net income will become positive soon because the amortization will drop significantly in the following half a decade. Maybe when that happens, they get more attention from the market, especially if they pay back some debt in the meantime. Again, even if the stock doesn't rise, after they pay the debt in 3 to 5 years, they can easily pay 10, 15, 20% dividends. You know, if they make 4 billion and free, let's say 3, that's 15% of the company. Be it in dividends or in buybacks, that's a very significant amount of money that the market probably won't be able to ignore. And that's the advantage of what for me is value investing. You know, if the market cap was, let's say 50 billion today, then it would have been a different story. The current assets don't cover the current liabilities, but that's a matter of timing and cash flows and short-term debt, so it isn't terrible. Despite a high amount of debt, most of which is fixed with an average interest of around 4.6% by the way, the assets are well above the liabilities. Even when taking the goodwill out, you are left with about 10.2 billion in equity. That's pretty much half of the market cap, meaning that all the potential of the intellectual properties, which isn't included in the balance sheet, is valued at like 10 billion. The thing is, with so many IPs from DC and Game of Thrones and even new Lord of the Rings movies coming soon, they have so much intellectual properties that they can offer a lifetime of content. And very importantly, DC, Harry Potter, Game of Thrones and so on have lots of fans, and when you announce a new movie or series in that universe, you already enjoy a guaranteed base of viewers. Having to do it from nothing is a different and more expensive and riskier story. A company like Amazon, for example, can even integrate these IPs into new games and Twitch or other branches, and also has the budget to develop them into new movies and series. They recently announced the Disney partnership, together offering an unbeatable amount of content. If anything, this can show Disney, Amazon, Netflix, Apple and so on how much potential there would be from an acquisition. Also very recently, they started the expansion of Max in Europe, which can unlock a lot of growth. I think they are the only major streaming service that wasn't available in the region. After this expansion, if the Disney partnership is going well, they could maybe even bring it to Europe. I said this a few times before, buying this for 40, 50, 60 billion wouldn't even be much for a company like Apple or Amazon, and even Disney and Netflix could manage to do it. I mean, Paramount got a 26 billion offer recently, and in comparison they have no IPs and are much smaller. Sure, they don't have the same amount of debt, but even on an equity level, after the goodwill, WBD has like twice as much. And then, comparing what you get from such a deal, 50 billion for Warner Bros. Doesn't seem like much. Still, even without a deal, if they keep repaying the debt and making even 3-4 billion in cash flows, this can be a much better company in less than half a decade. After that, if they share even a billion, that's already a 5% dividend. As for a valuation, let's look into 3 scenarios again. In a bad scenario, let's say they get back to 2 billion, which is what Discovery alone was making before the merger, and together they never made this little. For a ratio of 5, that's a market cap of 10 billion, meaning a price of 4.09, so pretty much a 50% loss. But what are the chances of this happening? And then wouldn't a company like Disney or Amazon simply buy them for something like 20 billion? You get 10 billion in equity, including useful assets and studios, meaning that all the potential of the IPs would be pretty much free at 10 billion. Now, in a second scenario, let's say they stabilize at around 4 billion. With a bit of refinancing, that's enough to pay the debt and the interest. For a ratio of 10, that's a market cap of 40 billion, meaning a price of 16.3. That's a 100% profit. However, even in this scenario, in 5 years of debt repayments, they would significantly improve the balance sheet. Then, they wouldn't have to worry about the debt, so they can use the money to develop or pay a dividend. Even 2 billion or half of the cash flow is a dividend of 10% today, and it would be very sustainable. In a good scenario, with Max offsetting the decrease of cable TV, let's say they keep making 6 billion. For a ratio of 10, that's a market cap of 60 billion, meaning a price of 24.51. So pretty much a 200% profit, similar to the price from 2 years ago. However, if they make so much money, that would significantly improve the balance sheet and the profit in just a few years. So the ratio could even reach 15, maybe 20, which would still be below the industry average, since most of the company's current problems would be solved. At a ratio of 20, that's 120 billion for a price of 49 and a 500% profit. Netflix, a company that after a decade of being the market leader, has finally made a similar amount of money, being at a ratio of around 40. Even Disney, after falling so much, is at a ratio above 20. Then they can easily pay the equivalent of an even 20% dividend today while also repaying the debt. Anyway, I think the current price is very good and I opened a position recently. So overall, WBD is definitely a buy for me. The risk-reward potential is simply too good to ignore. If they don't do well, someone probably buys them for at the very least 20-30 billion, and if they do well, they can pay massive dividends and buybacks. Again, Paramount, which has nowhere near this level of IPs and cash flows, got a bunch of offers above 20 billion. I think the market is really either exaggerating WBD's issues or simply not paying attention anymore, which often happens after falling so much. But on the bright side, that opens opportunities, and I think this one is definitely one of them. Sure, the debt is high and cable TV has a limited future, but they seem to focus on improving the business and avoiding these issues. So if they keep it up, Warner Bros. Can look like a much better company in even less than half a decade. But, it's a matter of management and a very dynamic environment. Still, I opened a position recently and I'm going to develop it around this price. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.